trade that hurts you the most is often the one you refuse to end. Not because the market moved farther than expected, but because you quietly changed the rules after the position was already open. What looked like patience slowly became hope, and hope disguised itself as discipline. The account didn't suffer from one bad entry. It suffered from one decision that was never made. That is an uncomfortable distinction, because it shifts the problem away from the chart and back to the trader. Price does not negotiate with your expectations. It simply reveals whether your original idea still deserves capital, the moment you begin protecting your opinion instead of protecting your account. The market has already taken control of the conversation. A stop loss is often treated as a technical setting, something to calculate after the excitement of finding an entry. Yet the market rarely punishes poor calculations as severely as it punishes poor commitment. If your exit changes every time the candle moves against you, then your strategy is no longer guiding your decisions. Your emotions are rewriting it in real time. That single habit quietly transforms manageable losses into lasting damage. Watch what happens after a losing trade. One trader accepts the loss exactly where it was planned and begins looking for the next opportunity with a clear mind. Another widens the stop just enough to avoid being wrong. Then a little more. Eventually the position becomes too large to close comfortably, and every small price movement feels personal. The market has not become more dangerous. The trader has become less objective. There is a reason experienced traders spend as much energy defining risk as they do searching for opportunity. Capital is more than money waiting to be invested. It is flexibility. It is the ability to act tomorrow because you remain disciplined today. Once that flexibility is damaged, every future decision becomes heavier. Smaller accounts begin forcing larger emotional reactions, and larger emotional reactions usually lead to poorer decisions. The cycle feeds itself. So before you think about where a trade could go in your favor, pay attention to something more revealing. Notice how quickly you become uncomfortable when a position moves against you. Notice whether you are following a predefined plan or negotiating with the market after the fact. That difference is subtle, but it determines whether your stop loss is serving as protection or merely existing as decoration on the chart. The challenge is not learning where to place a stop. The deeper challenge is understanding why intelligent traders repeatedly abandon the very rule designed to keep them alive long enough to succeed. And that is where the real conversation begins. The hardest trade to close is rarely the one with the biggest loss. It is the one that slowly becomes part of your identity. At first, you entered with a clear idea. You knew what you expected the market to do, and you accepted that the idea might fail. Then price moved against you, and something subtle changed. You stopped evaluating the trade and started defending it. That shift is easy to miss because nothing dramatic happens in a single moment. It happens one small decision at a time. The market does not ask whether you still believe in your position. It only reveals whether your original reasoning is being confirmed or challenged. Yet the mind has a different priority. It wants consistency. Once you publicly or privately commit to an idea, admitting that the idea is wrong begins to feel like admitting that you are wrong. Those are not the same thing. But under pressure they become difficult to separate. That is why intelligent traders can behave irrationally. Knowledge is not usually the missing piece. Most traders already understand that losses are part of the business. The problem begins when the loss changes meaning. Instead of becoming evidence that a trading idea failed, it becomes evidence that the trader failed. The emotional weight increases, and every tick against the position feels like a personal judgment rather than market information. Pay attention to the language inside your own mind. At the beginning of the trade, you may think, "This setup should work if my analysis is correct." A few minutes later, after price moves against you, the thought quietly changes to, "It has to come back." The first statement is based on observation. The second is based on emotional need. Nothing in the market created that change. Your attachment did. Once attachment replaces observation, the quality of every decision begins to decline. Information that supports your position suddenly feels more convincing. Information that challenges it becomes easier to ignore. You start searching for reasons to stay instead of reasons to evaluate. This is not because you have become less intelligent. It is because the mind naturally protects beliefs that feel connected to self-worth. In trading, that instinct can become expensive because the market rewards objectivity, not loyalty. A useful habit is to notice the exact moment when you stop asking, "Is my idea still valid?" and begin asking, "How can I avoid closing this trade?" Those questions may sound similar, but they lead in completely different directions. One keeps your attention on reality. The other keeps your attention on discomfort. The difference determines whether you are responding to the market or simply reacting to your own emotions. The goal is not to eliminate emotion. That is neither realistic nor necessary. The goal is to recognize when emotion quietly takes control of the role that analysis was supposed to play. If you can identify the transition early, you regain the ability to see the trade as it is instead of as you wish it to be. That awareness changes the quality of your decisions long before it changes the outcome of any single position. Understanding that inner transition is only the beginning, because even when you recognize it, another question remains: how do you build a trading process that prevents emotion from rewriting your decisions after the trade is already underway? A trade does not begin when you click the buy or sell button. It begins when every important decision has already been made. If you are still deciding where you will exit after the position is open, then the trade was never fully planned. You entered with an opinion, but not with a complete process. Execution is often misunderstood because it looks simple from the outside. A trader sees an opportunity, places an order, and waits. In reality, good execution is a sequence that cannot be rearranged without consequences. First, define what would prove the idea wrong. Then decide exactly where the trade should end if that happens. Only after those decisions exist should an order ever reach the market. Changing that order invites uncertainty into every step that follows. Consider what happens when this sequence is reversed. You find an attractive setup and enter quickly because you fear missing the move. Once the trade is active, you begin searching for a reasonable stop location. Now the market is already moving while your plan is still unfinished. Every new candle influences your thinking. A stop that seemed obvious a minute ago suddenly feels too close or too far. Your decisions are no longer being guided by preparation. They are being shaped by live price movement. That difference matters because execution depends on commitment, not speed. A predefined exit has one advantage that cannot be recreated later. It was chosen before money was at risk. Before the trade, your judgment is relatively clear. After the trade, every price fluctuation introduces pressure. The information on the chart may be identical, but your relationship with that information has changed because your capital is now exposed. This is why professional execution values consistency over flexibility. Flexibility sounds attractive, but in practice it often becomes hesitation. If every trade requires you to reinvent your exit while the position is active, your results become dependent on your emotional state in that moment. A repeatable process removes unnecessary decisions. Fewer decisions under pressure usually lead to better execution over time. You can test the quality of your own process with one simple question before every entry. If the market reaches my stop 5 seconds after I enter, would I accept that outcome without changing anything? If the answer is no, then something is still unfinished. Either the trade idea has not been fully defined, or the stop has not been genuinely accepted. In either case, entering early only increases the chance of inconsistent execution. Execution is not measured by whether a trade becomes profitable. A perfectly executed trade can lose money, just as a poorly executed trade can make money. The quality of execution is measured by whether every decision matched the plan that existed before the position was opened. When that standard becomes your focus, individual outcomes begin to lose their power to distort your process. The challenge, however, is that even a perfectly executed stop can still be placed in the wrong location if it ignores how the market actually moves. That brings us to the next question. Where should a stop logically belong in the first place? A small loss and a large loss are separated by more than money. They are separated by what each one demands from the future. Every dollar you lose today changes what tomorrow must produce just to return you to where you started. That arithmetic exists whether you pay attention to it or not. Trading often feels like a series of individual events, but your account does not experience it that way. It keeps a continuous record. Every gain builds on the current balance, and every loss reduces the base from which future gains must grow. Because of that, losses and gains are not mirror images of each other. A 10% loss does not require a 10% gain to recover. It requires more. As losses deepen, the recovery grows at an even faster rate. This is why preserving capital is a mathematical advantage rather than simply a cautious habit. Imagine two traders with equally good market ideas over the course of a year. One keeps losses consistently small. The other allows occasional oversized losses because they seem rare. Their winning trades may look almost identical, but their equity curves begin to separate. The second trader spends increasing amounts of time recovering from damage that never needed to happen. Notice what this means. The largest threat to long-term growth is often not a lack of profitable trades. It is the presence of a few losses that are large enough to erase the progress made by many smaller wins. A single uncontrolled decline forces future trades to work harder, not because the market has changed, but because the account has less capital available to compound. The same relationship exists inside every position. A wider stop is not automatically more dangerous, and a tighter stop is not automatically safer. What matters is the amount of capital exposed if that stop is reached. Risk is measured by the money that can be lost, not by the number of points or ticks on a chart. When those two ideas become confused, traders begin thinking they are controlling risk when they are only changing distance. This changes the way you should look at every opportunity. Before asking how much a trade might make, ask how much of your account is being placed in harm's way if the idea fails. That question forces you to measure the trade in objective terms. It removes excitement from the calculation and replaces it with proportion. Once risk is expressed as a small, predefined portion of total capital, one losing trade loses the ability to threaten the entire account. Over time, this creates an important shift in perspective. Instead of judging success by the outcome of the next trade, you begin judging it by whether your account remains healthy enough to participate in hundreds of future trades. The focus moves away from extracting the maximum profit from one opportunity and toward protecting the engine that makes every future opportunity possible. That mathematical discipline leads naturally to another question. Even if you know exactly how much capital you are willing to risk, the market still decides where a trade is truly invalid, and that is a different problem altogether. A stop loss should never exist simply because you have reached your personal limit of discomfort. It should exist because the market has reached a point where your original idea no longer makes sense. Those are two very different reasons, and confusing them leads to inconsistent trading. The market does not know where you feel uncomfortable. It only responds to the forces that move price. Every trade begins with a belief about what the market is likely to do. That belief is built on structure. Perhaps you expect support to hold, resistance to reject price, or a trend to continue after a pullback. Whatever the setup, there is always a point where the evidence no longer supports that belief. That point is not chosen for convenience. It is revealed by the logic of the trade itself. Markets rarely move in straight lines. Price expands, retraces, pauses, and tests important areas before revealing its next direction. Small movements against your position are often part of normal market behavior, not proof that the trade has failed. If your stop sits inside the market's normal movement, you are not protecting capital from a bad idea. You are protecting it from ordinary price fluctuations that every valid trade may experience. The opposite mistake creates a different problem. Some traders place stops so far away that almost any market movement is tolerated. In that case, the stop no longer marks the failure of the trade idea. It becomes nothing more than a distant emergency exit. When price reaches that level, the trade has usually stopped making sense long before the stop is ever touched. Distance alone does not make a stop more intelligent. This is why every stop should answer one clear Question what specific market behavior would prove that my analysis is no longer valid. Notice that the question is about evidence, not hope. If you cannot describe what price must do to invalidate the trade, then the stop has no objective foundation. It is simply a number attached to a position. Learning to recognize invalidation requires observing how markets naturally behave around important price areas. Swing highs and lows, support and resistance, trend structures, and periods of higher volatility all provide information about where buyers and sellers are likely to defend their positions. Your stop should respect those realities instead of ignoring them. Otherwise, you are asking the market to move according to your preferences rather than according to its own behavior. This way of thinking also changes how you interpret being stopped out. A stop is not evidence that the market treated you unfairly. It is evidence that the conditions required for your trade no longer exist. Sometimes the market will reverse immediately after your exit, and sometimes it will continue in the opposite direction. Neither outcome changes the purpose of the stop. Its job is not to predict the future perfectly. Its job is to define the point where your original reasoning is no longer supported by current price action. Once you begin viewing stops through the structure of the market, instead of through personal comfort, your decisions become more consistent. But even then, another challenge appears. Markets continue to evolve after you enter a trade, and the question becomes whether new information justifies a different decision, or whether you are simply reacting to movement that was always part of the plan. That distinction is where the next lesson begins. The market keeps producing new information after you enter a trade. That is normal. The difficult part is deciding whether that information changes your original idea or simply tests your ability to stay committed to it. Those two situations can look almost identical on a chart, yet they require completely different responses. Every trade is based on a specific expectation. You enter because you believe certain conditions increase the probability of a particular outcome. Once the position is open, price continues to move, volume changes, momentum shifts, and new candles appear. Not every new detail deserves a new decision. If you treat every movement as equally important, your analysis never has time to prove itself. This is where many traders confuse activity with judgment. They believe they are adapting to the market when they are actually responding to every small fluctuation. Constant adjustment feels productive because it creates the impression of control. In reality, it often weakens consistency. A decision that changes every few minutes is no longer guided by a stable framework. It is guided by the latest piece of information, whether that information matters or not. Reassessment has a higher standard. It asks a simple question: has something objective happened that invalidates the reasoning behind this trade? That question forces you to compare current market conditions with the conditions that justified the entry. If the underlying logic remains intact, then temporary movement alone is not enough to demand a different decision. If the logic has genuinely changed, then ignoring that evidence serves no purpose. The distinction may seem subtle, but it changes the quality of your trading. Reaction focuses on what price is doing right now. Reassessment focuses on what price means in relation to the original trade thesis. One is driven by immediacy, the other is driven by context. Context prevents isolated events from carrying more importance than they deserve. You can strengthen this habit by becoming very specific before entering a trade. Define the conditions that would confirm your idea and the conditions that would clearly weaken it. Later, when the market moves, compare what is actually happening against those predefined conditions instead of comparing it against your hopes or fears. This creates a reference point outside your emotions. It allows decisions to remain connected to evidence rather than urgency. There will also be times when the market presents genuinely new information that was impossible to anticipate before the trade began. A significant shift in price behavior may alter the quality of the original opportunity. In those moments, changing your decision is not inconsistency. It is a response to a different market environment. The key is that the change comes from objective evidence, not from the discomfort of watching price fluctuate. The market does not reward the trader who makes the most decisions. It rewards the trader who makes necessary decisions for clear reasons. Learning that difference protects your judgment from becoming reactive and keeps every choice connected to the logic that created the trade in the first place. Once that standard becomes part of your process, another question naturally follows. How do you make disciplined decisions consistently, day after day, without relying on willpower every time the market tests your patience? That answer lies not in a single trade, but in the habits that shape every trading session. Consistent traders rarely depend on making perfect decisions in the middle of a fast, moving market. They depend on habits that reduce the number of important decisions they need to make once the market is open. That difference is easy to overlook because habits are quiet. They do not attract attention the way dramatic trades do, yet they shape almost every result that follows. The quality of a trading day is often determined before the first order is placed. A trader who begins the session with clearly defined conditions, prepared watch lists, and written criteria enters the market with fewer uncertainties. A trader who starts by searching for opportunities without a structured plan must solve every problem in real time. The first approach preserves mental clarity. The second steadily consumes it. This is why professional habits are built around consistency rather than inspiration. Markets change from day to day, but your preparation should not. When the same sequence is repeated before every session, your attention is directed toward the market instead of toward deciding what to do next. Routine creates stability, and stability makes execution more reliable under pressure. Written processes serve an important purpose here. The mind remembers successful trades more vividly than ordinary ones, and it often forgets the small deviations that caused unnecessary losses. A written checklist has no such bias. It asks the same questions every time. Has the setup met the required conditions? Has the exit already been defined? Does this trade fit the plan for today? By forcing consistent answers, the checklist protects the process from becoming inconsistent simply because the market feels different. The same principle applies after the trading session ends. Reviewing completed trades is not about judging whether they made money. It is about asking whether the process was followed exactly as intended. A profitable trade that ignored the plan deserves as much attention as an unprofitable trade that followed it perfectly. Without that distinction, short-term outcomes begin teaching the wrong lessons. Notice how these habits influence one another. Careful preparation leads to clearer execution. Consistent review exposes recurring weaknesses. Those observations improve the next round of preparation. Over time, each routine strengthens the others until disciplined behavior becomes the normal way of operating, rather than something that requires constant effort. This does not mean every trading day becomes easy. Markets remain uncertain, and unexpected conditions still appear. The value of professional habits is that they provide a stable framework when uncertainty increases. Instead of inventing solutions under pressure, you return to a process that has already been tested. That keeps your decisions grounded even when market conditions are changing. If you want to evaluate your own professionalism, pay less attention to your best trading day and more attention to your ordinary ones. Can you prepare the same way after a winning streak as you do after a difficult week? Can you complete the same review even when you would rather move on? Those quiet repetitions reveal more about the strength of your process than occasional exceptional performance ever will. Once those routines become part of your trading, the next challenge is no longer preparing for a trade. It is managing one after it has begun. When the market starts presenting new opportunities and new risks that require thoughtful action without abandoning the original plan. The moment your trade is filled, a different phase begins. The work is no longer about finding an opportunity. It is about managing one. Many traders prepare carefully for the entry, but become uncertain once the position is active. They begin making decisions that were never part of the original plan, not because the market requires them, but because being in the trade feels different from preparing for it. A trade should not be managed simply because time has passed or because price has moved. It should be managed because the market has provided a meaningful reason to act. Every adjustment changes the balance between risk and opportunity. If those adjustments are made without a clear purpose, the trade gradually becomes a collection of reactions instead of a structured position. One of the most common examples is moving a stop too early. A trade shows a small unrealized profit, and the temptation is to eliminate all risk immediately. At first, this feels responsible. After all, who would object to protecting capital? But protection that ignores the natural movement of the market can become another form of interference. A trade that needed room to develop is closed before its idea has had a fair chance to play out. The opposite mistake is just as costly. Sometimes traders refuse to adjust anything, even when the market has clearly changed. A position that has developed in their favor may continue to be managed exactly as it was at the moment of entry, despite new evidence that suggests risk can be reduced without weakening the trade. Good management is not rigid. It responds to meaningful changes while remaining faithful to the original logic. The important distinction is that every adjustment should have a specific reason that exists independently of the trade's current profit or loss. If you move a stop, there should be an objective change in market conditions that justifies it. If you leave the stop where it is, that decision should also be supported by the same standard. The outcome of the trade cannot be the reason for the decision. The market itself must provide the reason. This principle also applies when taking partial profits. Reducing a position changes the character of the trade. It lowers exposure, but it also reduces participation if the move continues. Neither choice is automatically correct. The quality of the decision depends on whether it reflects a consistent management approach rather than a sudden desire to lock in gains simply because they are visible on the screen. Notice how trade management becomes a process of preserving clarity rather than chasing certainty. You are not trying to predict every future movement. You are responding to what the market has already revealed. That difference keeps your actions connected to evidence instead of imagination. As a result, each adjustment becomes part of an organized process instead of an emotional interruption. Well, managed trades do not require constant attention. In fact, unnecessary intervention often reduces their quality. The strongest management decisions are usually deliberate, infrequent, and based on changes that genuinely matter. Every action has a cost, even when that cost is not immediately visible. Even with a sound management process, traders still find ways to damage otherwise good positions. The problem is often not one dramatic mistake, but a series of small compromises that seem harmless in isolation. Those quiet errors deserve closer attention because they are responsible for far more losses than most traders realize. Major trading losses rarely begin with a single reckless decision. More often, they begin with a small compromise that seems too insignificant to matter. One exception feels harmless. One adjustment appears reasonable. One extra chance seems justified. By themselves, these choices hardly attract attention. Together, they quietly dismantle the structure that was supposed to protect your capital. The danger is that small mistakes often produce no immediate punishment. You widen a stop once, and the market reverses in your favor. You remove a stop on another trade, and the position eventually recovers. The outcome creates the illusion that the decision was sound. What was actually rewarded was luck. When luck repeatedly approves poor habits, those habits become more difficult to recognize. This is how inconsistency enters a trading process. Instead of following one standard every time, you begin making exceptions based on the circumstances of the moment. A trade that feels especially promising receives more room. A loss that feels unfair is given another chance. A setup that almost meets your criteria is accepted anyway. None of these choices seems dramatic, but each one weakens the boundary between disciplined execution and personal judgment. The problem is not that every exception fails. The problem is that every exception changes the rules. Once the rules become flexible, they stop serving as reliable guides. Decisions are no longer compared against a consistent process. They are compared against how convincing the current situation feels. Since every trade feels unique while it is happening, nearly every exception can be justified. Another common mistake is allowing one error to create the next. A poorly managed trade leads to an unnecessary loss. Instead of returning to the original process, the trader immediately looks for another opportunity to recover what was lost. That second trade is no longer evaluated on its own merits. It carries the burden of repairing the previous mistake. As expectations change, decision quality declines, and one compromise begins producing another. Some mistakes also remain hidden because they do not appear in trading statistics. A trader may record the size of a loss, but never record that the stop was widened first. Another may note the final profit while forgetting that the original plan was abandoned halfway through the trade. Over time, the record shows outcomes without revealing the decisions that produced them. Improvement becomes difficult because the real source of inconsistency is never examined. A useful way to identify these quiet errors is to stop asking whether a decision worked and begin asking whether you would want to repeat it 100 times under the same conditions. That question removes the influence of a single outcome. It shifts attention toward the quality of the decision itself. A process built on repeatable choices can survive ordinary market uncertainty. A process built on occasional exceptions eventually becomes unpredictable.